Hi everybody, welcome back to Banking Simplified with me, Devdarshini. So today I don't want to take you through complex formulas, banking terminologies, but I want to take you through a story. And for that, we have to go back to 2006 in the United States of America. So back in 2006 in the USA, the bankers, investment bankers, brokers were making a lot of money. Okay, they were getting rich. Then one fine evening, a group of investment bankers, brokers, they decided to go to a beautiful club. And then they were having drinks in the bar. Then one of the banker saw a beautiful bartender crossing him. And she was very happy. She looked like she was radiating too much happiness. So this banker, he was very curious. He wanted to know why was she so happy. Bankers being always in a stress, situation of stress. So when he saw her happy, he thought, let me go and ask her, what is this that is giving you so much happiness? So he went to her and put out his question. Then she said, sir, I'm really happy today because today I own a penthouse in Miami. Now this banker was shocked. So he said, how did you own a penthouse in Miami? What is your salary? She said, no, sir, it's not about the salary. I actually got a loan from the bank. The bank has approved my loan without taking too many details or going through my credit history or stuff. And now I am the owner of a penthouse in Miami. Okay. So this banker was shocked. And this situation was what was happening throughout the United States during the 2000s. People with less or bad credit history were also given out home loans by big banks. Now, why were these banks giving out these home loans? These home loans, the term that we will use throughout for home loans would be mortgage. Mortgage is the term that you will use for home loans because mortgages are real estate loans that banks and financial institutions give out. So all these banks were giving out mortgages, home loans, real estate loans to borrowers at a very large scale. And why was this happening? Because there was excess liquidity with the banks. Fed had actually gotten their rates low because Fed also wanted to increase the money supply, increase the credit availability in the economy. So Fed had also decreased the rates, because of which banks, financial institutions had a lot of liquidity with them. And at that point of time, government also wanted to give affordable housing to the people of the US. They wanted that people should own their own homes. So what happened in that time was that there was a spike in the housing prices. So 2006, 7, 8, prices were going up at a very high rate. Now, when the banks were lending out money, banks saw this as a very big business opportunity. How? When banks are giving out loans to these borrowers against the houses. So the houses worked as what? Collateral. So this bartender's property in Miami was the collateral basis which the banks gave the loan to the bartender. In case the bartender is not able to repay, because of course her salary is not that huge that she will be able to repay it on time. She may not, right? So in case she defaults also, what will the bank do? The bank will sell off the property in Miami. So in the US, that is how it had happened. So in case a borrower default, they could seize the property, seize the collateral and sell it off. They would sell off the collateral, someone else would buy that home, and the one who's buying that home from the bank is going to again take a loan from another bank and buy that home. So it was a cycle that was happening. There was a housing bubble, which means that housing prices were going up. Number of houses were also going because builders also started building a lot of houses because they knew that the demand of houses is going nowhere. Demand of houses are going up and up and up. So they started building more houses. Banks, financial institutions started giving out more home loans, mortgage loans to the borrowers, to the people of United States, irrespective of their credit history, a bartender, someone working in McDonald's, a waiter, everyone in the USA started owning homes. And these kind of loans which were given out without checking their proper credit history, without doing proper risk management of the borrowers, without knowing whether they have a good credit score or not, when you give out loans like that, those loans are called subprime loans. Loans which are not of high quality, which basically means that these loans could default anytime the borrower did not have the capability to repay. So housing bubble, increase of home loans, and this was an ongoing cycle that started to happen in the USA. Now, when these loans were getting created, banks started giving out more and more loans. There was a need for more money for the banks. So banks wanted to increase their business many folds, and to do that, they wanted more money. They had to raise more money. So to raise more money, banks created different financial instruments, one of which was the most important one, known as CDOs, collateral debt obligation. Before we understand CDOs, let us first understand this thing. So when these subprime loans were coming to the banks, now banks could not show that these are loans which are very bad quality, or these are loans that might default. So to monetize these loans, the bank bribed the credit rating agencies and rated these loans as very good loans. Now I hope you know that there are ratings that are given to various loans that banks have. So there are different kinds of ratings: AAA, AA, ICRA. For example, in India, there's ICRA, CARE rating agencies. So these rating agencies give industries, give borrowers a particular rating in this format. So AAA rated bonds or AAA rated loans are the best loans. For example, for them, you don't have to worry that they will not repay. For them, the probability of them losing, or the probability of losing out the repayments from these loans is very low. Then there are BBB rated loans, BB rated loans, non-rated loans. So these loans are so bad that you don't even rate them. You know that these loans are like, there's 90% probability, 90% chance that these loans will default. So what the banks did in the USA back in the 2000s, they bribed these credit rating agencies and they asked them to rate most of these loans as AAA rated, AA rated, or good ratings, irrespective of the background they had, irrespective of their credit worthiness. And this way, they started bundling up the loans. So the bank started bundling these loans up. So this was one bundle, this was another bundle. So every bundle had different rated loans. So maybe bundle A would have, for example, I'm saying 10 AA rated loans, 10 BB rated, 10 BBB rated. Similarly, bundle B would have. So this way they create a lot of bundles and they sold these bundles in the stock market as an instrument called the CDOs, credit default obligation. So CDOs were like any debt instruments. So when investors would invest in the CDOs, what would investors do? Investors would invest in CDOs. And they would get fixed returns. So as and when the repayments of these loans would come, the investors who had invested in the CDOs would get those payments. So it was like you are investing a lump sum money and you're getting the interest payments for that particular investment, just like any debt instrument that you invest in. So this was what was happening. when this was getting traded in the stock market, these CDOs, investors started buying them not just in the USA, but throughout the world. So you know, US market is like the central point. Even today, when something goes wrong in the US market, the entire world economy gets affected, right? So similarly, when CDOs came up in the stock market, they were giving very good returns because this mortgage business that was going on, the real estate business, the lending out for real estate was going really well because housing prices were going up, okay? So CDOs were giving out good returns, investors were investing on them all over the world. So it was not just the US investors in the USA. Then what happens? Suddenly, this person called Michael Burry, okay, he said that, okay, I will buy these CDOs, but he told the banks, I want insurance on these CDOs. That in case, if there's a situation that you banks don't get the repayments of these home loans, or if there is some kind of default that starts happening from the end of the borrowers, or if the home prices start to fall, then what is going to happen? My repayments from the CDO will stop. I will not get my due repayments from the CDO. So I want to buy an insurance from the banks. Now the banks were like, how can you ask for an insurance for something where prices will never go down? So supposing in Gurgaon, you buy a flat today for 10 lakhs. You expect or you know that within 10 years, this 10 lakhs is going to double. But if every 6 months your 10 lakhs is doubling, then there is something wrong, isn't it? So that is what Michael Burry had predicted. He said that, okay, housing prices may go up, but they can't go up to a level that they'll just keep on increasing. There'll be a time when it will come to a stagnancy or it will start falling. So for that, I want insurance against my CDOs. And for that, I will pay you premium. Just say, for example, for any insurance that you take, be it a car insurance, home insurance, you pay premiums, right? Till the time a disaster happens. So he said, I'm ready to pay the premiums. The premiums are high, that is okay. But I'm ready to pay premiums and buy the insurances. These insurances were called CDS, credit default swaps. So investors like Michael Burry, what they did, they started buying credit default swaps against the CDOs. Now what happened? Slowly, the supply of homes started to increase because banks were selling off these collaterals, the houses which were the collaterals, and the supply of these houses started increasing in the market. And in the USA, slowly, all these homes which were bought by the borrowers or by the people of the USA were all vacant because they had defaulted on their loans and they had given their property to the bank saying that you recover the money from the property and the banks would sell them off. Now there were no buyers for these homes because the home prices had reached a level that buyers also could not buy it anymore and banks could not sell it anymore. Banks did not have buyers for these collaterals. The collaterals were homes basically. And the prices of these houses started to fall. Demand and supply, right? Supply had started to increase. Demand was not there anymore. People did not want these loans and these loans, mortgage loans, started to become costly over time. And slowly, housing prices, as Michael Burry had predicted, started to crash. Now tell me, who do you think benefited from this situation? Michael Burry made billions of dollars because of the situation, because he had predicted this fall well in advance. So that helped him make the money at that time when every institution, every bank, every broker were making losses in the economy. the defaults started to begin. So by early 2000s, the subprime borrowers, they started defaulting on their loans. And there was instability in the market. And the biggest thing that happened was that as borrowers started to default, banks had also invested in all these different financial instruments which were getting created like CDOs in the stock market. Everything started to fall because the basis of everything were the home prices. And there was no proper risk management that was done to control it in case things went wrong. People were just making money when they were able to make money without thinking that what would happen in case things went in a different direction. And the biggest fall happened when in September 2008. That is when the Lehman Brothers, one of the oldest and biggest banks of the USA, fell. And when this happened, when Lehman Brothers went into bankruptcy, this effect was seen all over the world and it created a domino effect. So banks all over the world were shutting down. They were getting into insolvency because all of them had invested their money, most of them had invested a large chunk of their money in these different derivative instruments, financial instruments in the stock market, and everything started to crash. There was a global market plunge and major institutional institutions failed in the economy. Now, as this was happening, the government of the United States, of course, knew that this was the time when we will have to bail these financial institutions and banks out, because you know that banking is the backbone of an economy. If the banks fall, the entire economy falls, and that is when the global financial crisis created a huge recession in the United States, and government had to step in. Government brought in fiscal stimulus. They increased the spending in the economy. They started creating jobs. They started to bring in more kind of expenditure so that the money supply in the economy uses. Then Fed, just like the Reserve Bank of India is there for India, there is the Fed in the US. What did the Fed do? The Fed cut its rates to a low of around 1%, so that now the Fed could, so that there could be an increase in the money supply, the credit would increase, and banks would again start giving out loans. Now, banks did not have the liquidity also, and neither did it have the trust on the borrowers to be able to give out these loans. There was one thing that the government of the USA came up with. It was the TARP, Trouble Assets Relief Program. So in this particular program, the Fed made sure, which is the Reserve Bank of India of USA, the Fed made sure that, all these assets, all the homes, those were distressed, the collaterals, it started buying them and it started infusing money into the banking system. And it infused money to an extent of $700 billion in the USA under this TARP program. Now, a lot of the commoners, the common people, had invested in these instruments because, it happens in India also, right? When the stock market is going up, we all tend to put our savings, our money into it, thinking that we are going to make short-term money and become rich overnight. So that process, that thinking was there back then, and a lot of commoners had put in their money and they had all come to the streets because everything crashed. And for these people, for these commoners, there was this restaurant in the USA called Soup Kitchen where they were given free meals. So that is all the government could do for them at that point of time. So that was the situation. Now, what does this entire story tells us? This story tells us that it is very important for us to be, as bankers, or for the banks or the financial institutions of the economy or the country, it's very important for them to be able to identify what are the risks that they are taking when they are doing an investment or when they are giving out loans. Because if anything goes wrong, if there's something, if the predictions are not correct, if the risk management is not in place, the entire economy might go down along with the financial system. So this is what I would like to tell you. And also, I want you to tell me in the comment section, what were the other major reforms that had come up? Also, there were reforms in the Basel norms. Liquidity measures were made strict for the banks. Risk management had come in. Banks were asked to do stress testing. Okay, there were different capital requirements that were introduced. I want you to put it in the comment section below, and tell me what are the major banking reforms, 2 major banking reforms that had come up after the global financial crisis. I hope you've understood this entire crisis, what had happened, and why it is so important for bankers, for everybody. Because when I had joined my bank back in 2019, I was asked that, do you know the details of 2008 financial crisis? Because that helps you to know what are the right things to do and what not to do when you are sitting there as a banker, or when you're sitting as a commoner also. When you're investing your money, you will know when and where to invest and when not to invest. I hope you've understood, and I hope to see you in the next video again. Thank you.